Good morning and welcome to the Coinbase Institutional Markets Call. It is 11:35 Eastern on Tuesday, the 23rd of April. We have got a fantastic show today and we're going to be going through the Q2 Guide to Crypto put together by Coinbase and Glassnode. Now, full credit goes to James and David and their teams putting together a 59-page fantastic report with a ton of amazing insights. We are also going to be covering the following: the recent BTC Halving and market responses post that. We're going to have a great macro update because a lot has changed in the last week or so with regards to rate expectations in the US, which is super important for our asset class, and also an update on Mt. Gox. But before we get to that, there was a large conference in Dubai this week, and I think it was a little bit wet, and I think a lot of people really struggled, but thankfully I think everybody was safe. But George, you're a little bit closer to us. I don't think you were there, but perhaps you heard a few more stories. Like, how was it? Did the event end up being okay in the end, or was it all just a little bit of a washout?
Yeah. I mean, some people were joking that Dubai couldn't quite handle the liquidity, obviously. And I have to say, I did have some FOMO as well because, as you said, I wasn't scheduled to go. But then, it did look pretty rough the first day. But our team was out there, and actually, from what I heard, the events was actually still oversubscribed, and it was a really, really good event there.
I feel like whether it's like seeding the clouds or whatever, it's a really good filter. And anyone that is there really wants to be there and means business. I'm sure there was some super thorough and strong meetings there. Perfect.
100%.
Well, some quick housekeeping before we move on. If you're watching on YouTube, don't forget to scan the QR code on your screen right now to access the report I mentioned earlier on and all of the team's great research. If you are listening on podcast, that information will be in your show notes. And no matter where you're listening, please don't forget to like and subscribe and give us a 5-star rating. It helps us go up the charts, helps more people hear about us, and it helps us grow the crypto ecosystem. But without further ado, we are super, super excited to have James Check, lead analyst at Glassnode, with us here this morning in the US. But I believe it's pretty late for you, James. You're in Sydney at the moment. What time is it for you?
I am. It's just gone 9 o'clock. Great to be here, Ben.
Okay, well, appreciate you staying up late for us. We'll kind of keep it quick and snappy and get all the great content out of your report quickly through the call. Now, this report that we're going to run through is a report put together between Glassnode and Coinbase. So our very own David Duong and James and their teams have put this report together. It's an incredible report covering around about 75% of the crypto universe. So how does that break down? That's mainly BTC and ETH. If we just kind of zoom out and take a look at those two assets, the dominance for those two assets is around about 68, 69%. If we then include their equivalents, such as staked ETH and wrapped BTC, and you include stablecoins, you get to 76%. And as institutional investors look at the space, it's incredibly important to them, those two particular assets. And they're also the two that are leading from an ETF perspective, certainly BTC in the US and then BTC and ETH in other geographies as well. So that's what we're going to be discussing today. We're going to have a few breadcrumbs to the report. I'd highly encourage you to check it out on the Coinbase website, the Glassnode website. It's 59 pages of great insights, free of charge. So really make sure you go check it out. But James, we've just come through our halving, which is obviously always a very momentous occasion. There are some great Coinbase ads, which I'd certainly encourage folks to check out. There's some great stash or swag, as it would be called in the US, with around the halving. But it is an important milestone in some ways, and we do see some additional flows off the back of that. But let's just start there for today. How do you think about the Bitcoin halving, and kind of when you look at it on chain and in other ways, what are some of the kind of takeaways for you?
Yeah, for sure. I mean, the Bitcoin halving is one of the, it comes around every 4 years. It's an important milestone on the Bitcoiners calendar. And, in many ways, it kind of has two impacts. The first one is the market impact. Maybe I should correct. There's probably three impacts. The first one is what the reduction of issuance does on the market, right, in terms of price and reduction of sell side and all the rest of it. There's the miners, who obviously this affects quite a bit, right? They're losing 50% of one of their primary sources of revenue. And then I think there's another one, which is the, call it the narrative side, which is just that periodic reminder that this was set in stone when the code was initially launched. And it is just operating programmatically with nobody stepping in. And in many ways, we can kind of contrast that to some of the monetary policies we're running in the traditional world, and you can really see just the stark reality of them. And I think this halving in particular was interesting because it's dropped Bitcoin's issuance lower than gold's for the first time on a sustainable basis. So you could argue that Bitcoin is now, on an issuance basis, one of the scarcest assets to come by. So, it is a point of interest for many investors.
Very cool. And I guess with the narrative around digital gold, with the geopolitical risk we have around the world, and as you said, varied monetary policy, that's definitely something which kind of is a key factor. Now, if we just bring up this chart here for those viewing, and we'll talk through it for those on podcast, but we've got the performance since the halving. Do you mind just running us through this chart that you guys put together?
Yeah, for sure. So what we've done here is essentially looked at all of the different halving epochs. So we've essentially anchored there's different colored price charts for those who are listening for each of the different epochs, and they're all indexed to 1 or indexed to 0 at the point of the halving. And really what it's about doing is understanding how does the market historically perform, right? Of course, past performance isn't indicative of the future, but it certainly helps us just bound what typically happens. And what we generally find is that really the first 6 months after a halving, generally are actually pretty quiet. In fact, there generally chops around. There's a bit of a drawdown. It kind of moves sideways. But the following 365 days, in the last 2 cycles, because in many ways we can probably discount the early epochs. They were just a very different market structure back then. But if we look at the 2016-17 and the 2020-21 cycles, the market went through a bit of a lull in the first couple of months, but then we saw about a 600% return over that 360 day period afterwards. So, of course, it's all varied, but generally speaking, there's kind of this narrative that forms that is it the halving that creates these bull runs? Is it just people getting more interested in the speculation, or is it really the reduction in issuance? And, it's this question that gets debated every 4 years.
Yeah, it's a really good question to debate. I guess from an issuance perspective, just put some numbers on it. At 63K, it's north of 10 yards of issuance been taken out of the market, which is a serious amount. If you had a new hedge fund that was started that was buying that amount over the year, you'd be pretty bullish. So definitely see that as a positive thing. Now, one of the questions that we often get, and I'm sure you do as well, is like, how does the halving affect the miners? Obviously, the rewards are cut in half. So how do you think about that, and with regards to hash rate as well?
Yeah, absolutely. So in the scale of the market, if we look at trade volume, the amount that the halving has dropped at 450 Bitcoin, it's something like 100, 200 times smaller than our daily spot volume. It's 800 times smaller than futures. So whilst the halving is relatively small in a market sense relative to daily trade volume, it remains 50% of miner revenues. Now, this is actually where it's quite interesting. And I was thinking about this with my analyst as we were preparing this report. And one of the interesting observations is that hash rate has actually been at all-time high every single halving. So this is quite an interesting debate, because you would think that miners, if they know their revenue is going to get cut, they would be starting to wind back operations, maybe not investing as much. So as we pondered this question, we kind of came to some interesting insights. The only way for hash rate to be at all-time high or to continue trending higher is one of 2 things need to be happening. They can both happen at the same time. Either new rigs are being purchased, or more efficient rigs are being researched and constructed. So it's both of those are a capex. So if we think about what a stressed Bitcoin mining industry would look like, they would probably be taking their rewards and just barely scraping by with the machines that they have. They'd essentially be running on OPEX only. But as we see, they're adding more rigs and or researching and building new, more efficient ASIC chips, and both of those are a capex expense. So in many ways, they're actually expanding their operation. So there's a lot of debate around the Bitcoin security budget, but if you just take that very, very simple primitive and say, well, hash rate continues to go up even into the halving, it's telling you there's still enough cream on their revenue stream to actually continue to boost revenues, to actually expand their operations. Now, one last point on that. Not all miners are made equal. There are some miners who will have a stronger balance sheet and some that won't. So while the mining industry by and large is continuing to expand, individual miners may come under some kind of stress. So there's generally a lot of churn and rotation within the mining industry. And if that miner goes bankrupt, for example, then their assets will get sold at a cheaper price. Someone else will come in, buy up those rigs, and restart operations at a lower cost base. So internally, it can be a bit tumultuous, but externally, it continues to grow.
Yeah, so certainly a challenging industry that, and hats it to all those miners. The Coinbase advert, which I encourage folks to watch, really did kind of thank them, because it ultimately all the security does come down to the work that they do, and it's not always going to be glamorous, I'm sure. One actually amazing chart that you guys put together in the deck illustrates what you just said there around issuance from ETFs versus the supply. And for those watching, you can see here that the supply number is significantly below what the ETF demand is, and that's just purely ETFs. So obviously we've had a slightly different halving this time around, where we've got such an immovable force in these new spot BTC ETFs. But it does help to put into context just how large the ETF is and how manageable the new issuance is as well. And that's obviously been cut in half post the halving.
Yeah, and it's important to note here that this is actually the purple chart we're looking at is actually the net flows. So there's actually a much larger, there's been a lot of sell side pressure coming from GBTC, and the other ETFs are then absorbing that and some. So this is actually the net flow. In terms of total volume that's moving between these ETFs, it's much larger than what we see on the chart here.
Yeah, 100%. So the next thing I want to run through is portfolio diversification. As kind of these ETF providers kind of set up their marketing teams and they go out there, and the RIAs are going to start talking about adding a certain amount of Bitcoin or digital assets to your portfolio and what that does to your Sharp, your Sortino, etc. I know you guys did a lot of work on that, so we'd love to just kind of cover that out and kind of think about what adding some crypto to one's portfolio does, and is it the first 1% that makes a difference, or do you need to get up to a certain level, for example?
Yeah, absolutely. So over time, as the Bitcoin and the crypto asset space really has evolved, right? It's starting to move. I think these ETFs are probably a milestone in the move from adolescence into adulthood in their kind of development, certainly for Bitcoin. And as we move into this world where it's increasingly coming into TradFi portfolios, it is a relatively decorrelated asset over the long term. So when we look at, and this was the study that we did looking at it, a traditional 60-40 portfolio, bonds and equities, what happens if we add just a little bit of exposure to the crypto space? So if we add a 1% allocation to crypto, we actually improve Sortino ratios. And yes, there's drawdowns that occur typically on about a 4-year basis. And some of those drawdowns for Bitcoin can be 75% plus. But the returns during the off years are actually substantially higher. So it essentially rewards that downside volatility. Now, whether we measure it through Sharp ratio, Sortino ratio, Calmar, these are all typical metrics that we'll use to really balance a portfolio. The biggest impact that we saw is going from 0% allocation to 1%. Now, as you step up from 1 to 2 to 3 to 4 to 5%, you can run these different scenarios, but really the biggest impact of improving a portfolio's performance was actually the getting off zero, right? Which has been a bit of a meme and narrative in the space, but it really does show out in the numbers, which is quite incredible. And I think over time it will move closer towards it's been somewhat of a career risk, I think, to own this stuff in the early days. But I think we're moving closer and closer to the question goes, hang on a second, it's performing so well. Why wasn't there an allocation of some degree?
Yeah, I mean, I love this chart. You guys have done such a good job of breaking this down. Just as you do add, just the Sharp ratio just slowly goes higher. And anyone that's kind of invested will know that that's definitely a good thing for one's portfolio. Now, correlations is something else I want to run through. And you guys have done some great work there. Obviously, Sharp is important, correlations to other assets that you might hold in your portfolio. So especially in a world where we do see kind of geopolitical concerns in various parts of the world, and there's obviously the macro environment is changing pretty quickly. How should we think about this asset, Bitcoin, particularly as it's matured, with regards to some of these other assets that people may have in their portfolios?
Absolutely. And Bitcoin really goes through different phases. So there are certain periods, let's say 2021, where it was quite heavily correlated to traditional equities, particularly tech stocks. We've seen a lot of those correlations actually break down. And even if we look at our current market, we do have a lot of geopolitical tensions. We're actually seeing the 10-year yield is climbing again, which usually is a bit of a risk-off signal because the market's getting a bit antsy, being the bedrock of the economy. And yet Bitcoin we haven't actually had, this is a kind of a remarkable statistic, since the 1st of January 2023, Bitcoin's added over $1 trillion worth of market cap. And in that journey, from that point, it hasn't had more than 20% correction on a closing basis. So even though we've had a lot of these, there's a lot of geopolitical tension, the 10-year yield's rising, the dollar is strengthening. There's been periods of time where the dollar has strengthened as Bitcoin has sold off. In this instance, Bitcoin's actually performing quite well. So it kind of goes through the different phases where it's sometimes correlated, sometimes it isn't. But over the long term, it has historically been a fairly decorrelated asset. And we've actually seen it running alongside gold. And then we also see periods of time when that correlation breaks down. So as a portfolio diversifier, it really is starting to hold that role. It's not correlated to most things over any meaningful period of time.
Yeah, and I think that's so key what you added there, any meaningful period of time, because you always get commentators that will see stocks down, Bitcoin down, and it's very easy to kind of tell that story on a very short time basis. But to your point, like you got to zoom out a little bit and see what it looks like over a much longer period.
That's it.
Now, ETH is obviously an incredibly important asset in the space, and there's a lot of kind of different activity that happens on ETH that doesn't happen on Bitcoin, at least for now. We'll see how that evolves. Obviously, there's a lot going on there at the moment. But can you run us through like what some of the most important factors within the ETH ecosystem and maybe some of the charts that you like here?
Yeah, I think there's probably two main factors with the Ethereum space. The first one is just kind of closing out there is on the ETFs, right? There's obviously a lot of talk of is Ethereum, because it already has trading futures at the CME, which was a big part of the factor that got the Bitcoin ETFs approved. So I think that Ethereum, in terms of the ETF, is probably the next cab off the rank, and we are starting to see it getting approved in various other jurisdictions. So generally speaking, the US is kind of the leader, and then we see other markets tend to follow. In this instance, we're seeing a little bit of the opposite, where other jurisdictions are actually adding Bitcoin and Ethereum ETFs. And the question is whether the SEC will allow them in the US in the near term. Now, the other major component is the staking component. Now, Ethereum switched over to proof of stake in 2022. And really, the amount of coins flowing into the staking pool has been extraordinary, right? I can't remember the exact numbers, but I think it's getting up to over about a third of all ETH is now staked. Now, this has been fueled by a few different areas of demand. There's been the invention or the creation of what we call liquid staking tokens. So you can almost think about this like a tokenized version of the staking bonds, so to speak. So people don't necessarily have that illiquidity of their staked coins being unable to move. They can use them within the DeFi ecosystem and move them around as collateral. There's another component which is very, very early. And to be honest, I'm still trying to wrap my own head around it, which is the restaking component. And this is essentially taking that collateral that is staked in the Ethereum system and then essentially reusing that collateral to do all sorts of things, anchor into layer 2 chains, provide security to other blockchains, support Oracle pricing, all sorts of other mechanics. And this is a very, very new and emergent space, but it's essentially another layer of yield that gets stuck on top. And they're now going through the process of actually looking at tokenizing that as well. So you can have tokenized stake, you have tokenized restaked stake, and the thing can get quite complex pretty soon. But very interesting innovations going on in that space.
Yeah, we don't always make things simple, I think.
No, you'll get used to saying the word stake if you spend much time in the industry.
Yeah, 100%. And just for those viewers or listeners rather that can't see the chart, it shows starts at 2021 and going all the way to today, where the number of ETH stakes is a steady line up from 0 to 30 million with a market cap of north of 120 billion. So a steady state kind of growth there. James, the last bit I want to touch upon here is stablecoins. Obviously, an incredibly important part of the space. Again, an innovation that have only been around 3 or 4 years, and it's kind of easy to forget that. Obviously, Tether has been around a little longer, but how do you, when you look at stablecoins, how do you reference them versus where the market is going to go, and perhaps some of the indicators that you find important there?
Yeah, absolutely. So stablecoins really are that third pillar. We've got Bitcoin, we've got Ethereum and kind of the other L1s, and then we have stablecoins. And stablecoins really are where the market has found an extraordinary amount of product market fit. I like to think about them essentially as digital Eurodollars, which I believe is in many ways the way that they function. And stablecoins are actually branching out. So you mentioned they've only really been around for a short period of time. Tether's been around for a lot longer, but in terms of the scale of them, really it was from 2020 onwards, and even late 2020 when they started to explode. Now, the total market cap of stablecoins is about 130 billion. I think it's actually above that at the moment. So really quite extraordinary numbers. And really, this has a large dominance, about 80% thereabouts Tether, 20% USDC. There are some smaller ones, but by and large, USD-denominated stablecoins also dominate. We see very, very few crypto euros. They tend to be crypto US dollars. So not only are stablecoins finding a lot of use as like a collateral medium of exchange. I mean, in fact, many VCs will actually prefer to use stablecoins. They find it easier to actually transact in them. So it's being used within the crypto native ecosystem itself. But increasingly, we're actually seeing stablecoins proliferate across all manner of blockchains, even smaller chains like Tron and Solana. And because of the lower fee environment, we're actually seeing dollarization occurring in the developing world, in emerging markets in particular, where some of their local currencies just aren't as strong as the dollar. And they can't really weather the volatility of Bitcoin or ETH. So really a fascinating field. I mean, $132 billion is just quite remarkable in terms of their size. I expect it will continue to go higher. And in terms of some indicators we look at, because stablecoins are the quote currency on centralized exchanges, on decentralized exchanges, looking at their growth rate is kind of like dollar liquidity coming into the crypto ecosystem. So just in terms of the amount of crypto dollars coming in or out, I found it to be a really, really useful indicator for sentiment, risk on, risk off, because really it is that dollar liquidity that floats around the system.
Yeah, it's certainly, it's kind of amazing to think 130 billion again in sort of like a 4-year period. It's
big numbers.
And to your point earlier on, like dollarization around the globe, like if you're the US, like that's got to be a good thing to have.
Absolutely.
People working off your currency versus another. I think is potentially huge, and obviously, especially when you've got oil barrels being priced in one now and other things like that, where there's potentially a little bit of risk of some change in the reserve currency for some parts of the world. One would assume that the US could kind of really embrace those, but we'll see.
And one final point to that, which I think is actually really interesting, is that most of the reserves are held in treasuries, and the US government is going to benefit from a buyer of treasuries. So in that regard, stablecoins could in fact be a very important macro force moving forward. I think they're growing up pretty quick.
Yeah, I totally agree. One chart actually I just wanted to ask you a question on was the stablecoin network velocity. So when looking at this, I saw that USDT velocity was lower than USDC. Now, there'd always been this narrative that I'd heard that in Southeast Asia, people use USDT to pay for goods and services and things like that. But if I've read this chart correctly, that's potentially not the case. And you're actually seeing more people using USDC for goods and services than USDT. Is that right?
There'll be components here, because what we're looking at is network velocity on the Ethereum chain. So I mentioned that the stablecoin ecosystem is extremely broad, and actually this is true for all of the Ethereum and L2s, and these ecosystems are expanding at such a rapid rate that keeping track of where these dollars all are across all the different chains is a challenge unto itself. So you're correct. Generally speaking, in the world of Ethereum, most of the activity tends to actually be USDC. It tends to be the preferred currency. That said, if you move on to other chains like Tron or Solana, where it's a bit cheaper, Tether is actually finding a much, much larger product market fit. So technically speaking, there would be a network velocity per chain as well as an aggregate one. But this here, we're looking at the Ethereum mainnet.
Got it. Okay, that makes a ton of sense. Given it's much more expensive to transact on Ethereum, yeah, okay, that makes sense. But if we were to do the same chart for Tron or Solana,
correct,
then you'd probably flip reverse and USDT would be at the top.
That's it.
Interesting. Very cool. James, as always, such a pleasure to have you on. And I can't emphasize enough, people really should download the report. It's got so many great insights in there. And it comes out quarterly, I think. You and David put it together, is that right?
I believe so, yes.
Yeah, so it's a good update just to get up to speed with what's happening in the markets. And as you said, as people always say, like a picture tells 1,000 words. It's so much easier to see it when you've got 59 great charts for you. So, James, really appreciate you staying up. Thank you for joining. Great report. Congrats on that, you and David. And we will see you very soon.
Thank you very much. Cheers.
It is always so good to have James and David's report to kind of really, really zoom out and see what's happened over the last quarter. But now let's get into the weeds a little bit more about what's happened in the last week. So maybe, George, just bring you in here. Would love to kind of kick off with what you've been looking at in the market this week, maybe touching upon funding rates and other metrics like that.
Yeah, sure thing. Thanks, Ben. So price action over the last 7 days, so it's definitely a lot more positive than the week before that. geopolitics, reduced rate cut expectations in the US, taking a bit of a backseat. So we've seen BTC rallying around 4%. So we're now just testing this 67K level, ETH up around 2% as well. So just around 3,200. And if you bring up the slide, essentially, I think one of the things that has definitely contributed to this balance that we've seen across the market is essentially funding rates resetting. You can see that quite nicely here in early March. BTC was had funding rates of around 100% annualized, bit of a cool off, and then towards the quarter end, very late March, back up to like 70-80% annualized on BTC. And then since then, obviously, it's been much closer to zero.
Yeah, that's a great chart, that, and thanks to our friends at CoinGlass for putting that together. It's essentially, for those that are listening, it's a heat map which shows in brighter yellows where funding rates are slightly elevated, and then it's kind of a more dull green when they're lower. And you can really see across the entire ecosystem that funding really is pretty flat. Whereas if you rewound a month ago or so, when the ETF flows were really at their peak, it was lots of yellow and meme coins were at their best, etc. So it's a really great way of just quickly being able to see where funding is extended or not in particular assets. Now, George, I know you look at TA a lot as well, and seasonality is always something that comes into play as we move into summer. We get spring, we get some nice weather, but then we also get slightly tougher markets potentially. So curious, what are some of the levels that you're looking at from a TA perspective?
Yes, I think, I mean, if we stick to BTC as sort of the main one that will give the tone, set the tone, presumably for the market, I think we're now obviously around sort of mid-range, 66, 67K. And I think 67K, so we're claiming both 67 and 68K, looking at upside scenarios will be really key. We're claiming that on a daily close basis. I think if that happens after 68K, if you have a couple of daily closes above that, then there's a good chance for fresh all-time highs in BTC in the near term. I think another one that people have been watching and talking about a lot is the 200 period EMA or SMA on the 4-hour chart. That's really been very strong support over the last few months, and now basically it's around 67K. So we're just retesting that, and it's obviously resistance at the moment. So again, like if we break that, I think that will be a very positive sign. On the downside, obviously now the market is looking pretty strong, but just to cover the downside scenarios as well, I think if you lose 61 and 60K, then that would probably mean that there is relatively little support until 51 or 52K. But obviously, right now the market does look pretty good. And then Ben, you mentioned the seasonality as well. So obviously, you do have that old TradFi saying, "Sell in May and go away before your summer holidays." I think for BTC, I mean, what we often seen over the last couple of years is that it's been more of a like summers have typically been more of a like sideways kind of environment, which doesn't mean that you can't have like some DeFi summer or altcoin summer. So it'll be quite interesting to see how that dynamic behaves.
Yeah, for sure. And I guess it's interesting looking at the ETF flows. We had a period last week, and we're going to cover this with Greg in a second, where we saw a number of outflows, plus we were at the lower end of the trading range, yet Bitcoin held 60K really, really well, which was super impressive. But Greg, bringing you in here, digging into these ETF inflows, outflows, what is the latest there? Because it's still an area of focus for the market to really figure out what direction it's going next.
Yeah, so flows, like you say, are still a big focus. On balance, they have slowed some, though they still are positive. The days when we do have net outflows, that's generally because the outflows coming out of the Grayscale product just overwhelm the inflows going into the other products. So, there still seems to be this rebalancing going on. And, we've talked about it before. I think the turning point will be when you get net outflows out of the new ETFs, and we haven't seen that yet. So it looks to be just a continuation of kind of the beginning quarter of the year with new money coming into the space.
Yeah, I think you're right there, Greg. So IBIT have now had 70 days of growth, which I think is kind of getting up the record charts with regards to kind of consecutive days. George, like, how are you looking at ETFs? I guess you're obviously in Europe right now. When you talk to clients in the UK and various parts of Europe, how do they think about ETFs and other similar factors?
Yes, I think with ETF specifically and the inflows that Greg mentioned as well, I think a lot of investors are looking at it from a macro angle as well, right? And obviously we did have rate cuts getting increasingly pushed out further into the future in the US because the data, economic data that we've seen has been relatively strong. So the first rate cut in the US is now only getting priced in for September. And obviously there is sort of chatter in the macro community of rate cuts being optional altogether this year, if obviously or bar any larger sort of downside surprises in economic data. So I think that certainly also, like as Greg mentioned, I mean, maybe at some point we will see it's an asset that you can trade from both ways, obviously, and maybe at some point it's possible certainly to see some outflows from the newer ETFs as well. And I think the investors do look at the macro there as well, so that's definitely correlated. But I think the important thing is, like, even if that does happen, right, it's not to over-index on it, because in the longer term, I think the trajectory, especially with the halving as well, now from a sort of demand-supply angle, is pretty looking pretty positive.
Yeah, I think that's fair. David, from your seat, you're not talking to market participants quite as much, but you're definitely doing kind of the deep, I would say tougher research-related work. How do those kind of inflows and outflows look to you?
Yeah, I mean, outflows certainly they've slowed over the last week, but I think that is kind of discounting the bigger picture. There are a number of ETFs where net inflows and net outflows don't speak very much of their usability and their volumes. ETF trading volumes are still around $3 billion each day, even on outflow days or even on days where it remains flat. There are many scenarios of large ETFs that have had many billions of dollars of trading volumes without any net inflows and outflows for some time. So I think that inflows and outflows are certainly one part of the picture. Another part is just volume, liquidity, market depth, and just overall participation from a wider range of participants. And I think that that's something to also just bear in mind, that ETFs have also been extremely successful in terms of the activity that they get all across the exchanges.
Yeah. Now, Greg, going back to rates, I know you have a kind of a really strong macro view, kind of across the world of different assets. How important has the pushback of rate cuts been to Bitcoin and other risk assets in your view?
Yeah. So interestingly, the stock market came off some, but it's still, relatively elevated valuations. We're seeing sort of a similar story play out in crypto. Macro is important, and when we get the rate cuts, people are focused on, but it's not really the story that they're positioning around. I hear time and time again from clients, unless something big changes in the macro environment, like we go from expecting cuts to anticipating hikes, they're not going to change their positioning in crypto very much. So, it's unfortunate, and it certainly harms risk assets when we price cuts, out. And we went beginning of this month, we were expecting cuts in July and a total of 2 this year. Now, as George said, we're not expecting a cut until September and only 1 this year. So that does harm sentiment, but it's not enough to drastically change positioning.
And Greg, staying with rates, so the ECB were talking about going ahead with cuts in June, despite the fact that the Fed is probably going to be on hold a little longer. What does that mean for dollar strength and I guess the kind of the global economy more broadly?
Yeah, this sort of dichotomy between the U.S. central bank and kind of all the other central banks that are getting ready to cut or are cutting in the U.S., which is holding firm, should mean a stronger dollar, which is again going to be a headwind for our market, because Bitcoin is priced in dollars or stable coins linked to dollars. So it is something to keep an eye on. But again, unless it gets out of hand, I think we're going to trade more on crypto-centric sentiment, flows, and news.
And talking of those flows, we'll come to 13F filings in a second. But George, obviously within Europe, I saw a headline around an advocacy group trying to ask the SNB to add BTC to their treasury. Now, theoretically, a 13F filing that comes on the 15th of May, we could see some sovereigns holding IBIT, FBTC, et cetera, et cetera. How likely do you feel that is? And is that just a bit of a fun headline because the Swiss are generally pretty conservative in our experience?
Yeah, I think it's definitely more the latter, right? It's I mean, you do get these headlines on occasion, but I think it's probably some time away until you have major sort of G20 countries putting that on or central banks from those countries buying BTC. But let's see as you say. But it might be some time. I think personally, given as you say that they're quite conservative.
Yeah, but let's kind of play this game. Let's say 39 filings do come out, and we do see some kind of surprising holders. How bullish do we think that is for the space? And George, let's start with you.
I mean, obviously, if you're talking sovereigns, right, and some major ones, I mean, I think no one, that's definitely not priced, right? It's it's essentially priced very close to zero. So I think that would be extremely bullish, right? And same thing if you have like some, maybe other large asset managers or hedge funds, for instance, if they'll end up being on there, I think that would be quite positive. But it's also going to be a function of where is BTC trading at that particular moment in time, right? If let's say in the hypothetical scenario, by the time the filings come out, like we'll be trading at the 100K, right? Then probably the impact is going to be somewhat less than if we're trading still sort of the mid 60s or maybe the upper end of that range that we're in right now, around 70K.
Yeah, I think, it'll certainly be an interesting day, May 15th, when we get a chance to look at, who owns this. You have to sort of take it with a grain of salt because these filings, by the time we get them, are 45 days old. So especially when looking at hedge fund positions, some of that could be the basis trade. It could be, something they were in and out of very quickly. What we can see by looking now, because you can file early, is it's a lot of smaller sort of boutique wealth advisors. And I think that's an important story because, we are waiting for these products to be more readily available on the larger, wirehouse platforms. We talk about that all the time, but there seems to be the smaller boutiques that are sort of jumping the gun and leading the way here. And I think if we do get a meaningful or, name brand investor that files in this, it may make their sort of pitch a lot easier. Hey, so-and-so owns this, maybe you should as well. So, I'm looking forward to it. I think it'll be, an interesting list to go through. But again, as George said, there's only so much you can take away from these things.
Yeah, FOMO is certainly a real thing. I think your point around others pointing to who's doing what is meaningful and does matter. Now, changing gears a little bit, just going to the halving. We went through our fourth halving over the weekend. It was all completely successful. David, you've obviously been keeping a very close eye on that and helping our clients stay up to speed with the developments here. How did the halving go, and what are some of the things that we should be thinking about with reference to that?
Yeah, I mean, the halving went smoothly as it has the last 4 times. So block rewards, just to recap, went from 6.25 Bitcoin per block down to 3.125 Bitcoin per block. This equates to a $10.3 billion reduction in net new issuance of Bitcoin every single year. So that will definitely have some long-term impacts, even if historically there has not been too much price movement on the halving itself. One of the biggest things to note after the halvings, though, has been the launch of Runes, which is a new Bitcoin, token protocol. It's a kind of an alternative to BRC20s and inscriptions, and this has driven a lot of transaction fees. So in the chart that's up here, you can see that transaction fee, the rolling 7-day average transaction fees has gone up to around 27% of the total miner revenue. On the day of the halving itself, when Runes first launched, this spiked up to around 75% of all of transaction fees. That has since come back down to 30 to 40% over the last 3 days. And it looks to be a tapering around there. Historically, we have seen inscriptions drive up transaction fees in May and also in December and January, December of last year and January of this year. And those have typically been relatively short-lived, so a few 2 to 3 months. The spike in May was around 1 month. And so I think we're definitely keeping an eye out to see if these transaction fees are sustainable throughout the longer term.
Interesting. And what about Hashrate? We get a lot of questions about miners post the halving and their ability to continue in the way that they are and continue to invest in new capex and things like that. So how should we think about the mining sector and Hashrate?
Yes, certainly. A lot of our clients ask us, can hash rate keep growing up and to the right, which it has been essentially doing since the inception of Bitcoin. But one of the things that we've studied, and there's a chart on the screen I'll kind of describe it, is how much of the max theoretical hash rate is actually been realized. And the way we calculate the max theoretical hash rate is we make a few assumptions about the cost of energy. We're using $20 per megawatt hour, which is what Riot's average energy cost was. We assume that there's like around a 75% peak efficiency for all the ASICs. And then we can calculate the max, how much hash rate can the network support, assuming that every single miner operates at break even. And then we can compare that with the realized. And what we've seen historically is that the max realized hash rate compared to the theoretical is around 25%. In this gap, there's room for profitability, there's room for inefficiencies, there's room for operational costs and financing costs of miners. Right now, we're actually only at around 10 or 11%. And what this tells us is that there's quite a bit of room for hash rate to actually continue growing. On the one hand, the price appreciation of Bitcoin over the last 2 months has been incredible in supporting more realized hash rate. At the same time, transaction revenues have also gone up tremendously, even after the halving. And so it looks like there's still the network is able to still support an additional increase in hash rate as long as transaction fees remain high. Obviously, if transaction fees drop from today's 40% of miner revenue down to 5-10%, which it has been historically, then you can see this realized hash rate percentage drop and level out around 20%. But I think there's a big question around how these transaction fees will play in towards miner revenues going forward. That's the biggest question here.
And to your point earlier on, it's really hard to predict how runes or BRC20s or other ordinals, etc., how they continue to scale to kind of support that revenue. Let's just say that they don't kind of continue to grow at their current growth rate. What does that mean to miners? That they have to upgrade their equipment more quickly, or it's going to just be more competitive and therefore margins slightly worse off? Like how should we think about it?
So I think there's 3 main factors to look at here. The first one is the price of Bitcoin itself. The second one is transaction fees as a percentage of mining blocks, right? Like I mentioned, they're 40%, which is a huge amount of variable miner revenue. I think going to the halving, most of the public miners that I've looked at, they have plans to increase their hash rate going into the halving and in the few months following it, which means that mining is going to be more competitive. It looks currently that this is all able to be supported based on the transaction fee revenue and also the increased price of Bitcoin. Although the biggest unknown right now, in my view, is how long this transaction fee as a percentage of miner revenue will be able to be sustainable. If we see a big compression of this could be 40% off of top line miner revenue. Although right now there still seems to be sufficient margin for profits.
Cool, thanks, David. Always something to keep a very, very close eye on. Now, moving on to stablecoins, we've got a great chart here that you put together that is essentially showing us just the growth of stablecoins and kind of that we're very close to a peak that we saw in 2022. But David, maybe just for the listeners here that can't see it, can you just take us through this chart and maybe some of the lessons or insights that you take from it?
Yeah, certainly. I guess on the chart right now, what we're seeing the growth of stablecoins as in total, with USDT, USDC, and other stablecoins since early 2021. We hit a big peak in mid or early 2022, but following the Terra Luna collapse, we've actually dropped from 185 roughly billion and to 160 billion, which is the level we're currently at today. So we've currently come back from a big dip back down to all-time highs minus the Terra USD stablecoin. And so we see a large growth actually in collateralized stablecoins, which has been the fastest growing segment of the market. USDT, USDC issuances are back towards all-time highs. We see some growth in Athena and some of these other coins as well, but the big story has just been a lot of new capital flowing into the space from these collateralized stablecoin issuers.
I think it's fair to say that when we see supply of stablecoins grow, like it typically runs hand in hand with a healthy market. Is that fair to say?
Yeah, absolutely. Some of our other research has shown that trading volumes go up in line with stablecoin issuances, both on chain and on centralized exchanges as well. So one of why we think that stablecoin issuances is kind of like a heuristic for liquidity in the space and how much new capital is flowing into here.
Cool. Thanks, David. Greg, switching gears a little bit, Mt. Gox, I know it's something that you keep a super close eye on. I think we had an update last week. What do we need to know?
Yeah, we very recently got an update. Basically, the TLDR is we're progressing towards a distribution. Some creditors are, posting on Reddit and other boards that when they log into the portal, they're now seeing the amount of Bitcoin and the amount of Bitcoin Cash that will be distributed to them. So it's just one more incremental step until these tokens are finally distributed. The total, just to remind everybody, it's about 142,000 Bitcoin that will be distributed to creditors and about 143,000 Bitcoin Cash. How meaningful it'll be for the market is really a question mark because we don't know what the bulk of these creditors are going to do with it, whether they're going to hold it or look to sell it immediately. But it is something that the market keeps a close eye on. And, it's when these wallets do finally move, there will be some volatility.
Perfect. Well, for those that are listening, you're not missing much. Shown is a website that looks like it was built in 1985 with some information about all of the claims. So it is all online. You can check it out. We'll leave a link in the show notes. But obviously, it's something that the market is definitely keeping a very, very close eye on. Other fun things, Greg, curious your thoughts on these ones. First was New York Stock Exchange contemplating 24/7 trading. If they're smart, they won't do it because trading 24/7 is really tiring. But what do you think? Is that likely to happen?
I saw that and I immediately thought of all my friends that still work in TradFi. And I said, they're going to love this.
Yeah.
It'll be interesting to see if it happens. There's a lot of, it's difficult to do from a technological standpoint because it means exchanges can't have downtime. So it's hard to, maintain everything that goes into having an exchange. But retail is a larger and larger portion of trading volumes these days. And, if it's something that they want, the exchanges will likely find a way to give it to them. It'll be an interesting story to follow, though.
Yeah, it's definitely a challenging one to get once you've got all your settlement partners and custodians and everything like that on board. And then the other one I saw, which I thought was interesting, was FTX auctioning the next round of locked SOL tokens. And the last time they did this, I don't believe it went via an auction. So it looks like here they're trying to maximize value a little better. That feels like a sensible move, I think, on that side of the estate. Does that feel fair?
Yeah, I think it'll be, I'm not sure exactly yet how the auction will work. There's a number of different ways you can run auctions. But I think they likely did learn that maybe they offered too large of a discount in this past tranche, and they're just trying a different approach to maximize creditor value. So it's something we'll have to keep a close eye on, especially as a lot of the folks that participate in these auctions are also in liquid SOL. And so we see flows in the liquid side of the market, when these big blocks are being shopped.
Yeah, 100%. Great. Well, that is a wrap. Thank you, everyone. Thank you, James, for joining from Sydney, and thank you, David and George, as well. Now, please don't forget to download the Q2 Guide to Crypto Report. It really is fantastic. A ton of great charts in there, and all free of charge. So check that out. And otherwise, have a great week, and we will see you next week. Take care.